Welcome you all. Now we are discussing a very important topic, gold loans in India. New RBI rules explain. India's love for gold is legendary, but in 2025, it is not just about jewelry or investment. Gold loans have become one of the fastest growing financial products. As per the latest RBI data, gold loan portfolios skyrocket by 76.9% in January 2025, compared to just 17.4% last year. So with this explosive growth, the RBI has now stepped in the draft guidelines that could change the way gold loans are sanctioned and managed. So in this video, we will cover why gold loans are surging, the numbers behind the boom, and the key proposed regulations, how this impacts banks, non-banking financial companies, and borrowers. Let's get started. So, why gold loans are gaining unprecedented traction? See, India's gold plan. See, if you see India's gold loan portfolio stood at 1.79 lakh crore in January 2025. This is up from 1.01 lakh crore in 2024 and 86,133 crore in 2023. So, what is causing this spike? So, number one is record-breaking gold prices and tightening credit elsewhere. Accessibility of low credit profiles, cultural and seasonal triggers. There are the reasons. See, the record-breaking gold price we have seen, the gold price, it is thus nearly 98,000 or 1 lakh, 10 grams. So making pledged gold more valuable and increasing loan eligibility for borrowers. Tightening credit elsewhere, if you see, any personal and business loans, there are higher interest rates. Borrowers find gold loans attractive for their quicker process and lower cost. This is also another reason. And accessibility for low credit profiles. Since gold loans are secured, even individuals with low or no credit history can access funds and easily. And another reason, cultural and seasonal triggers, because the wedding and festival season further boost demand for the such quick credit solutions. Where is the market heading? See, according to ICRA, so the projection from September 2024, the gold loan could rise even 15 trillion by 2027. NBFCs are expected to clock 17 to 19% growth in financial year 2025. Banks with their agricultural linked gold products continue to dominate. So despite aggressive expansion, the credit cost has been manageable at below 0.5% over the past 5 years. So thanks to secured nature of these loans. See the risk beneath the shell. However, not everything is glittering. In 2025 budget session, GNPA's gross non-performing assets for gold loans jumped by 18.14% between March to June 2024. So banks had a modest GNPA ratio of 0.22%. But non-banking finance companies reported much higher, 2.58% of gross non-performing assets. So this divergence in asset quality is one of the driving forces behind RBI's proposed change. So the key changes, RBI's draft guidelines, one is purpose-linked loan monitoring. Purpose-linked loan monitoring. So this is loans will now need to classified based on the purpose, consumption, Another one, income generating. Lender must document end use for income-based loans and cannot combine both categories in a single loan. It has to be divided. The impact would be the loan application forms and internal tracking systems must be revamped to monitor fund usage. Another one is reworking loan to value, that is LTV rules. LTV rules. So loan to value rules. Now the existing rules are NBFCs must maintain 75% of LTV at loan origination. So in the beginning. But the draft proposal, LTV must be maintained throughout the loan period, not just at sanction. So for consumption loans, 75% of capital is mandatory for all the lenders. For income generating loans, NBFC is capped at 75%. For banks, flexibility allowed based on the internal policy. And bullet repayment loans. So LTV to be assessed at the end of the loan tenure. Because after end of the loan tenure, then bullet repayment loans. And that LTV, the loan to value to be assessed at the end of the loan tenure in case of the bullet repayment loans. If breached for 30 days plus, then lender must make 1% additional provisioning. If any breach delay above 30 days. Cannot review such loans. So the impact would be increased compliance pressure, especially to non-banking finance companies amid fluctuating gold prices. And another point is enhanced customer due diligence. RBI wants to lenders to go beyond just the collateral. So repayment capacity and loan against old gold loan. Repayment capacity must be evaluated for all borrowers. And loan against old gold only. So this means it prevents misuse or pledging of unverified assets. And loan cap. This is maximum 1 kg gold allowed per borrower across all lenders. And bullet loans, this is capped to 12 months for consumption. So these are all proposed. And top up and renewals and strict rules, only standard loans can be renewed. And no LTV breach allowed. So the impact would be loan processing could slow down. Lenders will need better KYC and monitoring systems. And another one, stricter rules for collateral handling and auctions. So gold valuation to be done by qualified valuer and in borrower's presence only, the valuation will be done. And a transparent methodology posted online. So e-certificate of collateral. Details like carat purity, weight of the gold, and image, photograph, and valuer name and value. And collateral release. So this is also a good invite. So must be returned within 7 working days. If delayed, then lender pays 5,000 per day penalty. If it is delayed beyond 7 days. And auction reserve price, minimum 90% of market value. Earlier it was 80%, now proposed 90%. And must refer to IBJ or SEBI registered exchange data. So the impact would be strong borrower protection norms. So NBFCs and banks must digitize and professionalize asset management. So now we'll discuss comparisons. How these draft norms compare with current rules. I'll explain in detail. See the present 2023 master data directions, the LTV loan to value monitoring. At the beginning only, at the time of sanction only, at the origination only. Whereas in draft guidelines 2025, this LTV monitoring will be continuous monitoring. And end use classification, at present not mandatory, but draft guidelines 2025 says end use classification mandatory with proof. And bullet loan tenure at present actually not clearly defined the tenure. Now it is maximum 12 months for consumption. It is proposed. And the auction rules, At present, 85% reserve price. Now it is proposed for 90% reserve price and collateral return time. Actually, not time bound now, but it is proposed 7 days. Otherwise, penalty. So, what this message? So, what this means for lenders, for banks and NBFCs, for banks, no, this is a regulatory advantage with the LTV flexibility. Need to scale up monitoring systems. Comes to the non-banking finance companies, higher compliance cost, risk of margin pressure if gold prices decline. Need to enhance borrower assessment and diversify product portfolios. Strategic shift is required. NBFCs must focus more on borrower capacity, borrower capability, rather than just collateral. Adopting digitized workflows and potentially explore other secured loan models to balance the risk. So now the conclusion is India's gold loan segment is booming, driven by rising gold prices and demand for accessible credit. But with the growth comes regulatory tightening. So the RBI's draft guidelines aim to make gold loan ecosystems safer, transparent, aligned across banks and non-banking finance companies. So while compliance burden will rise, the long-term effect could be a more mature and resilient lending market. So welcome. If you are a borrower or a lender or a finance enthusiast, do share your thoughts in the comment box. Don't forget to like, share, subscribe for more deep dives into India's evolving financial landscapes and more videos on corporate laws. We have two channels. One is RR Corporates, another legal channel, RR Legal Talks. So kindly subscribe both the channels for regular updates without missing. Hope we are clear. Thank you.